The modern financial system, rooted in fiat currency, operates on a foundation of inflation, often referred to as the invisible tax. Unlike overt taxes, inflation reduces purchasing power, subtly eroding the value of money over time. This process allows wealth to be siphoned away from the public without legislation or direct intervention. Compounding inflation exacerbates this issue. Each year, as the value of money diminishes, the cost of goods and services rises, leaving less wealth in the hands of ordinary people. The most alarming aspect is that this system is intentionally designed. By allowing inflation to persist, central banks and governments can finance debt while quietly diminishing the purchasing power of savings. What appears to be a benign economic mechanism is, in reality, a systematic method of wealth confiscation. The impact of inflation is starkly visible when comparing wages to the cost of living over the decades. In 1971, the average wage in the United States was approximately $9,500. Back then, a family of 4 could comfortably survive on one wage earner's income. Today, the average wage is around $57,000, yet 2 income earners often struggle to make ends meet. This disparity reflects the disproportionate rise in living costs compared to wage growth. Housing, education, healthcare, and basic necessities have skyrocketed in price, pushing even middle-income households into paycheck-to-paycheck living. Shockingly, individuals earning up to $250,000 annually also find themselves unable to save, highlighting the pervasive strain on financial stability. This economic squeeze, driven by inflation and stagnant wages, leaves most people vulnerable to sudden financial shocks. Amid these challenges, the global financial landscape is undergoing a dramatic transformation. For decades, the West, particularly the United States, dominated the world economy. However, this hegemony is being challenged by emerging powers in the East, including China, Russia, and India. Central banks in these nations have been accumulating gold at an unprecedented rate. This strategy underscores the enduring significance of gold as a store of value and a symbol of economic independence. During financial transitions, gold becomes a cornerstone for stabilizing economies. In the 1960s, central banks amassed gold to prepare for shifting monetary dynamics. Today, they are doing so again, signaling an imminent change in global power structures. As Eastern nations strengthen their financial independence, the West's reliance on fiat currency and debt-based systems becomes a glaring vulnerability. The power shift is not merely economic, it represents a broader rebalancing of global influence. Central to this shift is the declining dominance of the U.S. dollar as the world's reserve currency. Since the 1940s, the dollar's status provided the U.S. with unparalleled economic advantages, including lower borrowing costs and global demand for its debt. However, no currency retains this status indefinitely. The dollar's decline began around 2000 when the Federal Reserve started buying back government debt to stabilize the economy. This practice, unpublicized at the time, reflected underlying weaknesses in the financial system. By 2009, quantitative easing and other measures became necessary to prop up the dollar, further eroding its credibility. Today, the global community is accelerating efforts to reduce reliance on the dollar. Trade agreements bypassing the dollar, increase gold reserves, and the rise of alternative currencies signal the rapid erosion of its reserve status. The consequences for the U.S. economy are profound, including diminished global influence and heightened vulnerability to financial crises. The United States faces a looming threat of hyperinflation, a scenario where prices rise uncontrollably, rendering the currency virtually worthless. This risk stems from unsustainable debt levels across governments, corporations, and households. To finance its debt, the U.S. government relies on issuing more currency, which fuels inflation. However, this strategy has limits. When debt surpasses the economy's ability to sustain it, the system collapses. Hyperinflation becomes inevitable as confidence in the currency wanes. Governments and corporations, already maxed out in their borrowing capacities, face dire consequences. The inability to take on more debt signals the end of a debt-driven economy. In such a scenario, savings evaporate and purchasing power plummets, leaving citizens financially stranded. The U.S. Treasury market, once considered the bedrock of global finance, now shows alarming signs of instability. Treasuries, which represent government debt, are a cornerstone of the financial system. They provide liquidity and serve as benchmarks for other assets. However, liquidity in the Treasury market has been deteriorating. Traders are increasingly betting on Treasury defaults, reflecting a loss of confidence in the U.S. government's ability to manage its debt. This fragility threatens to destabilize the entire financial system. The Federal Reserve's attempts to prop up the Treasury market, including buying back treasuries and increasing its balance sheet, are temporary fixes. The underlying issues remain unresolved, signaling deeper systemic weaknesses. In the face of financial uncertainty, gold emerges as the ultimate asset. Unlike fiat currency, gold retains its value over time and is immune to inflationary pressures. It represents financial sovereignty and a hedge against economic instability. Central banks worldwide recognize this and are accumulating gold at record levels. This trend underscores the belief that those who hold gold will control the future financial system. Gold serves not only as a reserve asset but also as a tool for exerting geopolitical influence. For individuals, gold offers a way to preserve wealth amid economic turmoil. As the fiat system falters, gold becomes a lifeline, ensuring financial security in an uncertain world. The current financial system is reaching its endgame, paving the way for a global reset. This reset encompasses social, economic, and financial transformations driven by unsustainable debt and systemic inefficiencies. Negative interest rates, a tool increasingly used by central banks, reflect the desperation to sustain the system. These rates penalize savers and force spending, further eroding financial independence. The transition to a new system involves centralized control over financial transactions. Central bank digital currencies, CBDCs, are a critical component of this shift, enabling authorities to monitor and dictate spending. While presented as innovations, these measures consolidate power and limit individual freedoms. Technological advancements are amplifying this centralized control. Smart contracts, embedded in devices like self-driving cars and smart homes, enable corporations to enforce compliance. For instance, missing a car payment could result in the vehicle locking itself or driving away autonomously. These innovations, while convenient, pose significant risks to personal freedom. They grant unprecedented power to corporations and governments, enabling them to control access to essential resources. The implications extend beyond financial transactions, affecting housing, mobility, and daily life. This level of control underscores the importance of protecting individual autonomy in a rapidly digitizing world. In light of these challenges, financial independence and self-sufficiency become paramount. Relying on centralized systems exposes individuals to risks, including inflation, debt, and loss of autonomy. Practical steps include diversifying investments, holding tangible assets like gold, and reducing dependence on debt. Building local communities and fostering economic resilience are equally important. The road ahead is uncertain, but by prioritizing independence and preparing for systemic changes, individuals can navigate the shifting financial landscape. As the old system collapses, those who adapt will emerge stronger, ensuring their financial security in the new era.